All right, so in this class, we're going to primarily talk about short sales. Um, and short sales is a transaction in which an investor is actually selling stock that they don't already own. And they're trying to make money because um, they think that the price of the stock will go down. And if the price of the stock goes down, they'll be successful, they'll make money. And that's why they're doing the transaction, or they might be hedging another position that they're holding. And so there are a lot of reasons why investors will want to sell short stocks. Before we get into a discussion of short sales, I'd like to talk about another code section. And that's a code section that facilitates and the investor's ability to make a short sale. So I'm going to share my screen and we're going to pull up the PowerPoint and discuss code section 1058. And so what is code section 1058? It's going to be the one code section that we're going to talk about in this course where we're going to have, it's going to be a non-recognition transaction. So for those of you who have taken corporate tax or partnership tax, you know that when you make a contribution to a corporation, as long as you meet certain requirements, the 80% control test and other requirements, then if you've contributed appreciated property to the corporation, you don't recognize any gain or loss. And the same thing with partnerships. And with partnerships, we don't have this control test, but when you donate appreciated property or contribute appreciated property to a partnership, it's a non-recognition event. You don't have to recognize the gain. You don't get to recognize the loss. And then we have various basis rules. But the key to those provisions is that we don't have to recognize gain or loss. So in securities, the one transaction that we're going to talk about this semester in which you don't have to recognize gain or loss is when someone lends out their security. And you might be saying, why would someone lend out their security? And what's going on here? So years and years ago, investors actually used to have physical possession of their securities. And that just doesn't happen anymore. But back then, if I had physical possession of my General Motors shares and I wanted to sell them, I would put an order in with my broker, I would sell the shares, but then I would have to deliver the shares to the buyer when the trade settled. What if I didn't submit and get the shares to my broker in time? I had them in a vault and for whatever reason I couldn't get them. What would the broker do? And what the broker would do is they would borrow shares from someone else, make delivery of those shares. And then when I finally deliver the shares, they would then return the shares to whoever they borrowed the shares from. And that was very important back then because you wanted a fluid market. You didn't want buyers having to worry that when they were buying shares of General Motors that they actually might not receive them. So it was very important that the brokers were able to borrow the securities. That reason really doesn't exist anymore. But what does exist is that people still want to be able to sell securities short. They think a security is going to go down in value. So let's assume IBM is trading at $100 a share. Now, for whatever reason, you think IBM is going to go down. What you could do is sell it short now. You could borrow the shares from somebody, deliver those shares to the buyer. They're going to pay you $100 a share for the IBM. And if IBM goes down to $80 a share in the future, then you could go back into the market, you'll buy shares of IBM at $80 a share, and you'll then deliver the shares back to the person who lent them to you. And you'll make $20 a share. So that would be a good short sell. And good being that the short seller made money. But in order to be able to do the short sale, they first have to be able to borrow the shares. And so now the question is, what's happening when someone lends you their shares? And when we talk about short sales, I'll show a diagram of this transaction and we'll go into it in a lot more detail. But basically what's happening is the lender is giving you their shares and you're transferring them to the buyer. When the buyer gets the shares, they become the record owner of those shares. The lender is no longer the record owner of those shares. So they really disposed of their shares. Now, in the example I just gave, if the lender gave you $100 worth of IBM and you sold it to a buyer and you received $100 in cash, the lender is out their shares. Now, yes, you've entered into an agreement to give them back the shares, but the lender wants security. And what the lender is going to ask for is the $100 that you just received from the buyer. And so when you look at the transaction from the lender, it looks like they've sold the shares and it looks like they've disposed of the shares and they've taken in the money. They've gotten the $100 and they turned it into cash and they can do whatever they want with that cash. Now, when the borrower gives them back their shares, they'll give them back the $100. But until that time happens, they've got the use of the $100. And so it looks like a disposition. It looks like the lender should pay tax, have a taxable event. But Congress said, no, that's not what's happening. They're really retaining an interest in the security because they're going to get the security back. And when they get the security back, they're going to return the $100. So it really is a lending transaction. And we don't think that there should be any recognition of gain or loss. Now, in order for you to do that, you have to meet certain requirements. And the requirement is that when you lend out the securities, the borrower has to return the same number of shares back. And that way you've retained the same beneficial ownership in the shares. If I lent out one share of IBM at 100, when it was worth $100 a share, and IBM goes up to $120 a share, when the lender returns that one share back to me, the value of my shares is going to be, $120. It's the same as though I had never gotten rid of the share. And likewise, if the price of the stock had gone down to $80 a share, when the borrower gives the share back to me, I'm getting stock worth $80. It's as though I never got rid of the shares. If instead I said, by the way, I'm lending you $100 worth of IBM today, no matter what IBM is selling for in the future, you're going to give me back $100 worth of IBM stock. That's not going to be a good non-recognition transaction because I've now insulated myself from the price movement in IBM. And I've really changed my economic position. And now my securities loan transaction would be a taxable transaction. Also, what happens if during the life of the transaction, IBM pays a dividend? I'm not going to get that dividend anymore because I've lent the shares. The buyer of the shares is now the record owner. They're the ones who are going to receive that dividend. So in the agreement, the borrower of the shares has to make that dividend payment to me. And again, when we go through a diagram and we go through numbers, I'll show you why that has to happen economically. So there are two major things that have to happen in this agreement. The agreement has to provide for the return of the identical securities, and it has to provide that if there are any dividends, any other distributions made with respect to the securities. So if I lent the bond and there was an interest payment, the lender of the bond has to be entitled to the interest payment. So those things must be in place in order for the lender not to recognize any gain or loss on the transaction. Now, if the lender doesn't have a taxable event, there's no tax obstruction, restriction as to stopping them from lending out the securities. It's a non-event for tax purposes. And again, when we go through the diagram, we'll go through the economics to everybody. You'll see why people are doing this, or better understand why people are doing this. And with having no tax recognition, there's no reason for them not to do the transaction. And the final thing is, when they do the transaction, they can't reduce their risk of loss or opportunity for gain with respect to the securities. So that gets to the point that I made, that when I lend out one share of IBM, I have to be entitled to just get back one share of IBM. I can't limit it to a dollar amount where I'm limiting my risk of loss or opportunity for gain. That again is going to make it a bad 1058 transaction. This is under code section 1058 of the Internal Revenue Code. That's where the rules can be found. And once those requirements are met, we have a non-recognition transaction. And where does 1058 come into play now? It gets involved in prepaid variable forward contracts. Those are going to be things that we're going to discuss later on in the semester. But just remember that in order to have a good prepaid variable forward contract, if we violate code section 1058, we're going to defeat the purpose of the contract. And cases have come up where that's happened. And dealers and people doing these transactions to hedge their stocks will make sure that they don't violate this section 1058 requirement. And as I said, we're going to talk about prepaid variable forward contracts in a couple of weeks, and we'll come back to what they have to do to make sure that they don't violate section 1058 when they enter into those transactions. So this is just a precursor of things to come in the course. And there was a case, Samueli, that involved the lending of a bond. And Samueli wasn't, the lender of the bond wasn't allowed to just call the bond back whenever they wanted to. They were restricted in the number of times that they could actually ask Mr. Samueli to return the bond. And the court said because the lender was restricted from being able to ask for the bond back, and they could only get it back at certain times, that affected their opportunity for gain on the bond. Because if the bond went up in value, they didn't have the right to just call it back and be able to sell it. And so the court ruled that it was a bad section 1058 transaction. And Mr. Samueli didn't get the tax results that he expected. So this code section, while it doesn't come up that often in cases, does come up, and it's something that we should all be aware of, and we should know its requirements to make sure that we don't violate code section 1058 and turn what we think is a non-taxable stock lending transaction into a taxable disposition. So again, the big thing with 1058 is that the lender lends out securities. What they're entitled to receive back are the same number of shares or the same amount of bonds in the future. There doesn't have to be a fixed date to get them back, but the lender has to be able to call the securities back almost at will, with 1 or 2 days notice, in order to not violate the holding in the Samueli case. They also have to be entitled to receive all distributions with respect to the underlying security while the security is lent out. And if we meet all of that, we meet section 1058. And again, the main reason that section 1058 is important now is to facilitate short sales. So now let's get into short sales. We'll diagram the transaction. We'll go over the parties involved. And we're going to talk about all the applicable code sections. And the applicable code sections, again, are going to be 1058. That's going to that code section is going to relate primarily to the lender of the shares. Then we're going to talk about section 1233. Section 1233 is going to deal with the short seller and how they treat gains and losses with respect to the short sales. We'll then talk about code section 263H, because when the short seller, the borrower of the shares, makes these payments, these dividend payments or these interest payments, how are those payments treated for tax purposes? And code section 263H will talk about that. And then finally, we'll talk about investment interest expense, section 163D3C. And that tells you how to treat these payments that are made on short sales, and that they're treated as interest expense for tax purposes, and specifically they're treated as investment interest expense. So let's get into what is a short sale. And again, for those of you who had me in 627, you know I like to diagram things, you know I like to write things out. So let's look at a diagram of a short sale. And as you can see, there are three parties involved in a short sale. We have the short seller, and the short seller is the person, the entity that is actually selling the security. As I said, they're selling a security that they don't own. And the reason, again, that they're doing this is because they want to sell it today at a higher price and then buy it back in the future when the security has gone down in value. And that's how they're going to make money. And how are they going to make money? Because because on day one, when they sell the stock and they don't own it, they have to borrow the stock. So they find a lender, and the lender lends them the stock, and they immediately sell the stock, and they receive cash from the buyer. Now, the buyer doesn't know that it's buying the stock from a short seller. The buyer gets the stock, they become the record holder of the stock. If there are any dividends paid on the stock, the company just pays the buyer directly. The company now puts in their books and records that the buyer is the owner of the stock, and they strike the lender's name from their books and records. The lender is no longer the owner of the stock as far as the company is concerned. And if there's a dividend, they're not going to pay the lender, they're going to pay the buyer. So the buyer is going to be subject to all the tax rules that we spoke about in the prior class. They're going to have normal holding period requirements. They're going to receive dividends. If they hold the dividends for the requisite period of time, they'll get the preferential treatment on the dividends. But all the rules that we spoke about last week apply to the buyer. What we're going to focus on today are the tax rules on the short seller and the tax rules applicable to the lender. So again, when the lender lends out the stock, they're going to want collateral from the short seller. And the short seller is going to take the cash that they received from the buyer, and they're going to give it to the lender, and that's going to serve as collateral. So if the lender lent $100 worth of stock to the short seller, and the short seller goes away, the short seller loses all their money, the short seller doesn't have the ability to pay the lender back their stock, the lender is protected because they've got the $100 of cash. And as the value of the stock fluctuates, the amount of collateral, that cash is collateral, will fluctuate. So if the stock goes up to $105 a share, the lender is going to call the short seller and say, hey, you have to give me another $5 of collateral. And likewise, if the stock goes down, let's say the stock goes down to $97 a share, the short seller is going to say, hey, I gave you too much collateral. You've got $100 of collateral, and the stock is only worth 97. Give me back $3. And so money will constantly go back and forth between the short seller and the lender based on the value of the underlying stock. Now, the lender might say on day one, hey, you're giving me $100, but I have no cushion. If the stock goes up to 101 and you don't post the additional dollar of collateral, I'm going to be out that dollar if you default on the loan. So on day one, the lender might ask for 103% of the value of the stock. So the short seller might have to post $103 in my example as opposed to 100. But again, and then every time the stock goes up, the lender still wants that 3% cushion. So they're still going to ask for more cash to be deposited. And if the stock goes down, the short seller again is going to say, hey, you've got too much collateral. You have 103% based on 100. If the stock goes down to 97, you have a lot more, you have more than 103%. Give me that excess back. And that will continue during the life of the transaction. But if you think about it now, the lender no longer holds stock. The lender now has $100 of cash. And what are they going to do with that cash? They're not going to just leave it as cash. They're going to invest it. And I understand in today's interest rate environment, they're not going to make a lot of money, but they will make something. So they're probably going to buy US Treasury bonds. And let's assume that the bonds that they buy are paying 1% interest. So the lender is now getting that additional 1%. And they would like to keep as much of that 1% as possible. Again, when you go back 30 years ago, and investors weren't as sophisticated as they are now, they didn't really realize what was going on and that the lender was earning all this interest income. And in the past, lenders were able to keep all of that interest income. Buyers, eventually people started diagramming the transaction, started understanding what was going on in the transaction, and said, hey, lender, you're earning all this interest, but that's really my money. I'm just giving it to you as collateral. I want that interest income. And as time has developed, right now, the short seller gets between 80 to 90% of that interest income. And the lender keeps between 10 and 20% of that interest income. But it's that 10 or 20% of the interest income that the lender is earning that they wouldn't have otherwise earned if they just held on to the stock. So that's how they're being compensated for lending out the stock. They're getting 10 or 20% of the interest income that's earned on the cash collateral, but the bulk of the interest income that's being earned on the cash collateral is going back to the short seller. That's another income stream that short sellers earn from entering into the short sale. So now that I've talked about it, let me put some numbers on this. And so let me go to the whiteboard and we'll come up with an example that has numbers. So again, for those of you who've had me, I guess all of you have had me for tax 627, you know I like to use the whiteboard. So we have the lender, and let's use $1 million. We have $1 million of IBM. And we have the short seller. So the short seller sells $1 million of IBM. And then finally, we have the buyer. So the buyer receives the stock and they pay $1 million. So the short seller, let's go back to the short seller now. The short seller sells the $1 million of IBM. They receive $1 million in cash. And now let's go back to the lender because the short seller, and so now they receive the $1 million from short seller. The short seller has to return, so they have an obligation to return the shares to lender. And how are they going to return the shares in the future? They will purchase the number of shares they borrowed. And after they make the purchase, then they will return the shares. And again, economically, they're going to hope that when they buy back the shares, that they've gone down in value. And so if they can buy back the shares for $800,000, and it's the same number of shares, but the value has gone down because IBM has gone down in value, their profit is $200,000 on the short sale. Right? Hopefully everybody sees that. Right when I'm teaching, and if I could see your faces now, I could see if you're following this or not, but hopefully you can follow this. It's really not that complicated, right? So what happens to the lender now? Eventually the lender gets their shares back. And they return the collateral. Okay. Let's assume that this transaction was held open for 1 year. So it was held open for 1 year. And let's assume that the lender was able to earn 1% on the money during the life of the transaction. What would have happened is the lender would have earned $1 million. I'm sorry, 1%. They would have earned $10,000 in total of interest income. The lender would keep $2,000, let's say, and the short seller would get $8,000. Because remember, it's the short seller's money. It's being held by the lender as collateral, but it really is the short seller's money. So after the transaction, the lender has the same, they're left with the same number of shares. So they have their shares back. Plus, they've made $2,000. And as long as they have enough collateral to make sure that the borrower isn't going to stiff them by not returning their shares, they've taken on no additional risk. They still have the same risk and reward that they had before with respect to the shares, but now they have an additional $2,000, right? And if we start adding zeros to these transactions, all of a sudden they're starting to make a lot of money, right? Instead of doing $1 million, let's assume I did $100 million worth of IBM. Instead of earning $2,000, they would have earned $2 million, right? So lenders are making money by doing this transaction. And the only thing that would have stopped this transaction is, let's assume they had $1 million worth of IBM and they had a very low basis. Let's assume they had a zero basis. If they lent it out and the lending transaction was treated as a taxable event, they would have never done it. They would have incurred a tax by lending out the stock, and it would have been multiples of the amount of money that they're trying to make from the transaction. So in order to allow these transactions to happen, it's very important that we have Code Section 1058, and Code Section 1058 tells the lender they don't have to recognize any gain or loss when they lend out the shares. This is the basic economics though. So the lender is making money by earning interest on the cash that they receive from the short seller. They still have the same economic position that they had before in the IBM stock. And those are the economics of the lender. The short seller, on the other hand, never had an interest in IBM stock. They think the IBM stock is going to go down in value, and they want to take advantage of the IBM stock going down in value. So they sell it today, and they're looking to buy it back in the future. And that's the way they're going to make money. it's taking what you normally think of in an investment, that you're buying things and you want them to go up in value, and it's flipping it. It's putting it on. It's on its head. And it's the exact opposite. The short seller wants to make money because they think the market will go down. The price of the stock will go down. And that's the economics to the short seller. And in addition to making money because the price of the stock will go down, the short seller is also earning interest on the short sale proceeds. And they're getting about 80 to 90% of the interest. So those are the economics to the short seller. And the buyer could care less that this is a short sale, a regular sale. They don't care. All they know is they bought $1 million worth of IBM stock, and they're hoping that the stock goes up in value. Now, what's interesting about a short sale is that it really is it's like a derivative contract. For every dollar that the short seller makes or loses, the buyer is going to make or lose the exact same amount. So if they sold short IBM when the IBM was worth $1 million, the buyer bought the stock when it was worth $1 million. If the short seller gets to buy back the shares for $800,000 and they have a $200,000 profit, they may not be buying the shares back from the same person that they sold them to. But if the buyer is still holding the shares, they're holding shares that have gone down to $800,000, they've lost $200,000, right? So when the short sale is actually creating a derivative transaction on the stock, in a sense, and short sales will end up being a sum zero game with whoever's buying the stock from them. So keep that in mind as well. So these are the economics to the lender. Those are the economics to the short seller. Those are the economics to the buyer. So let's go back to the PowerPoint. And we'll continue on. So this is the diagram, and now we've started to go through the economics of the transaction. So again, let's just repeat. For the lender of the securities, what's happening economically? They are no longer the record holder of the shares. As far as IBM is concerned, in my example, they've disposed of their shares. They've transferred the shares to the short seller. The short seller has transferred those shares to the buyer. The buyer is now the record owner of the shares. What's important for that? Because of that, the lender of the shares, because they're no longer the record owner of the shares, they're no longer going to receive dividends from the company. The company's going to pay those dividends to the buyer. And they also can't vote the shares anymore. So if there's going to be a shareholder vote, the lender is no longer a shareholder for legal purposes. They can't vote the shares. Only the buyer can now vote the shares. Now, they're not getting the dividend from the company. They're going to get the dividend from the short seller. So that's part of the agreement. Because they're going to get back the same number of shares that they lent out, they're retaining economic exposure to the underlying security. If the company paid a dividend, they're still going to get the dividend. That retains their economics in the security. And as I said, they're going to pay the lion's share, 80 to 90% of the interest that they're earning on the cash, and they're going to pay that back to the short seller. But they're keeping that 10 or 20%, and that's how they're making money on the transaction. And the collateral that they receive, they're going to change. If the price of the security changes on a daily basis, that collateral is going to change on a daily basis as well. And that's how they protect themselves. I just want to go back to the whiteboard because I want to go over what's going on with the dividend and why it's imperative that the short seller pay the dividend to the lender, because otherwise it'll mess up the economics. So let me just move this over. Let's make this a full screen. We'll get out of here. Let's erase all of this. And of course, as you all know, you can all go back and look at the recording. So if you want to go over what was on that whiteboard, you can always go back to the recording and then stop it there and take a look at it and take notes and make sure that you understand everything. Okay, so now we have the IBM in total was worth $1 million. And IBM pays a dividend. And let's assume the dividend, just to make the numbers easy, pays a dividend, and the dividend is a 5% dividend. So they're paying a $50,000 dividend. All other things being equal, when a company pays a dividend, the price of their stock will go down by that amount. Because whoever bought the stock before the dividend paid $1 million for this stock. If I'm going to buy that stock from someone after they've paid out $50,000, I'm not going to pay $1 million for that stock anymore. I'm going to pay $950,000 for that stock because the company has $50,000 less in cash. So after the stock pays the dividend, that stock's only going to be worth $950,000. All other things being equal. Now, the price of IBM is going to change every day, so it's not going to be perfect. But the split second after it pays that $50,000, the value of the stock is going to go down to $950,000. So if you were the lender and you just owned IBM stock, before the dividend, you would have had $1 million worth of IBM stock. And then after the dividend, you would have $50,000 in cash. And you would have $950,000 in IBM stock. And you still have $1 million worth of assets. But now you're no longer getting the dividend from IBM. And the value of the stock now that the lender, that the borrower is going to give you back is only worth $950,000. So you were going to go to the short seller and say, hey, short seller, I didn't get that $50,000 from IBM. You give it to me. And that's now going to come from the short seller. And so after you get the $50,000 in cash from the short seller, you now are going to have your $50,000 in cash. The short seller now has to return the IBM stock to you. That IBM stock is worth $950,000, and you're back to $1 million. So in order to make the economics work, you must receive any distribution with respect to the IBM stock, because it's going to go down in value by the amount of that distribution. And the short seller is in the same position also, because remember, the short seller originally owed you $1 million worth of stock, right? That's what they owed. Now they're going to have to pay $50,000 in cash. But now the amount of stock that they owe is only $950,000. It's only worth $950,000 value of stock owed. And so they're in the same position that they were before. Before they owed $1 million in stock. Now they're out $50,000 in cash, but they only owe $950,000 in value of stock. So their net payable or net decrease in assets is still the same $1 million. So the payment of the dividend has to be made for economic purposes. And that's why it's there. It's not unfair to the short seller to demand that they make that payment, because as they're making the payment, the value of the stock that they then have to repay is going down by a similar amount. So there's equilibrium. So those are the economics of this transaction. We've talked about the economics to the lender. We've now gone over the economics to the short seller. And now let's go over the taxation. So the taxation to the lender is all governed by Section 1058. There's no gain or loss recognized on the transaction. The net income earned from the collateral is ordinary income. But remember, they're no longer getting a dividend from the company. They're getting an in lieu of dividend, a payment made to reflect the dividend, but it's coming from the short seller. Now, if you receive dividend income, as we talked about, if you're a corporation, you get a dividend received deduction. So if I receive, in our example, if I receive that $50,000 and I received that from the company and I was a corporation, I would have $50,000 of dividend income. I would get a dividend received deduction of 50% of $25,000, and I'd only have to pay tax on $25,000. That goes away. I'm no longer getting a dividend from the company. I'm getting the dividend from the short seller. That now is ordinary income. And I should be aware of that, because if I'm a taxpayer and I'm lending out my shares, and if I'm a corporate taxpayer, I'm losing that benefit. And I'm going to pay more tax on that income. And it's all treated as ordinary income. And again, let's just quickly go back to the whiteboard and see why we need, why Congress has come up with that result, and why it really is a fair result, and it's the right result. The lender has an interest in $1 million worth of IBM. But who else has an interest in $1 million worth of IBM now? The buyer. Buyer owns $1 million worth of IBM. What the short seller has done is the short seller has artificially increased the number of holders of IBM stock, because economically the lender still has an interest in $1 million of IBM stock. And as well as the lender having an interest in $1 million worth of IBM stock, the buyer has an interest in $1 million of IBM stock. When IBM makes a dividend payment, IBM is only paying $50,000. So there's really only $50,000 of dividends coming from IBM. And the government says, well, we're giving you a benefit with respect to dividend income, whether you're an individual or a corporation. If you're an individual, you pay a lower rate of tax on those dividends. If you're a corporation, you get the dividend received deduction. And we only want those rules to apply to the amount of dividends coming from IBM. So the buyer will qualify for the DRD if they're a corporation. Or they'll qualify for the lower rate of tax if they're an individual. Right? So it makes sense for the buyer. Now we come to the lender, and this is why the lender has to be careful. They're receiving their payment from short seller. Okay, it's no longer a dividend. Instead, it's a payment made with respect to a contract. So it's a receipt from the point of view of the lender, receipt of money related to a loan. So for tax purposes, this is ordinary income. We've converted what would otherwise have been treated as dividend income and subject to some really good tax results to ordinary income that's taxed at ordinary rates. And the lender has to be aware of that. Now, what's interesting is the vast majority of stock loans in the United States are made from tax-exempt institutions. And so they really don't care that they're losing the qualification of the income as dividend. They're not paying tax anyway. So then you might say, well, why are they even worried about 1058? And the reason that they're worried about 1058 is there's something called unrelated business income. That's taxable to charities. And what charities were afraid of was stock lending has nothing to do with their charitable organization, and that they were afraid that it was going to be unrelated business income and they were going to have to pay tax on it. And that's why charities were the driving force as to why Section 1058 was enacted in the first place. And one of the largest lenders of securities in the country is Harvard University. They have a massive endowment. The endowment is invested in, all these different stocks. And when people have to borrow stocks, they know to come to Harvard because Harvard has just a vast quantity of stocks available for lending. And Harvard then earns that additional interest income in addition to the rate of return that they're earning on the stocks. All right. But the key for this point is that the lender has converted the nature of the income that they're receiving on the underlying security. That is why if you're a taxable investor, you will never lend out a tax-exempt bond. If you lend out a tax-exempt bond, the interest income that you would have received on the bond would have been tax-exempt, not subject to tax. Now you're receiving it from the person that you've lent the bond to, and all of a sudden that tax-exempt bond creates taxable income. So you would never lend out a tax-exempt bond if you're a taxable investor. Okay, we've gone through the economics of the short seller. They're selling stock they don't own. They're selling it into the marketplace. Eventually, they're going to buy the stock back. They want to make money because of the decrease in the price of the stock. And as we said, they're obligated to make payments to the lender. I have borrower in here. It's to the lender for all distributions with respect to the underlying stock. They're the borrower. So I have to fix this slide. Unless it's contracted for in the agreement, the fact that the lender is losing those tax characteristics, that's the lender's problem. The borrower does not have to make that up to them. Now, sometimes the lender will say, hey, I'm losing the dividend received deduction. I want you to pay me for that. And they might work out an agreement with the short seller that in addition to the dividend payment, you also have to pay them an additional fee to make up for their lost tax benefits. That's extremely rare. And as I said, the vast majority of stock lending is made by tax-exempt institutions in the United States. So that very rarely, if ever, comes up. But unless the lender protects itself contractually in the lending agreement, the borrower never has to make up the lost tax benefits to the lender of the stock. Again, remember the added benefit to the short seller is when they receive the cash from the buyer and they post it as margin to the lender, they're going to get the lion's share of the interest income earned on that cash collateral. So in addition to hoping that the price of the stock goes down in value, they're also earning interest income on the collateral. Okay, what's the taxation finally to the short seller? The code section that governs the short seller is code section 1233. So the first thing that code section 1233 says is very simple. We look at the asset that you're using to make the delivery to close the short sale and the character of the gain, and really also the amount of gain or loss and the nature of the gain or loss, whether it's long-term or short-term capital gain, is all based on the characteristics of the property that you're using to make the delivery to close the short sale. So let's just go through a simple example again. And so let me go back to the whiteboard. Let's erase all of this. Let's make this really big. Okay. So the short seller on 9/21/2021 sells short 10,000 shares of IBM for $1 million. And they don't own any IBM shares at the time of the short sale. And so they closed the short sale on 10/3/2022. They buy new shares, right? They buy shares of IBM. They buy 10,000 shares of IBM. And they had a good transaction. They only have to buy them back for $800,000. And on 10/3, they place the order to buy the shares back. When do they receive the stock? They don't receive it for 2 more days because it takes 2 days for transactions to settle. So on 10/5/2022, they receive the shares and deliver them to the lender. For tax purposes, the transaction is deemed closed or is closed on 10/5, not the day that they entered into the market to buy back the shares, but rather the day that they made delivery to the lender. That's what closes the transaction. And it typically isn't the sale that starts the transaction, it's the borrowing of the stock, but the borrowing of the stock and the sale always take place on the same day. So we look at this transaction and you say, okay, I have a $200,000 gain, right? Our amount realized is our short sale proceeds. Our amount realized is $1 million. What's our basis in the stock? The basis in the stock is our cost in the stock that we're using to make the delivery. That's $800,000. And we have a gain of $200,000. And so now the question is that long-term gain or is that short-term gain? And on initial blush, your initial reaction might be that you entered into the transaction on 9/21/2021. We closed the transaction on 10/5/2022. So the short sale was held open for more than 1 year. And so you might think that, oh, the short sale was held open for more than 1 year. We have a gain. The IBM stock is a capital asset. We're not a dealer. We're not a trader. We're not a hedger. We're an investor. So it's clearly a capital asset. And again, your initial reaction, looking at this at first blush, you might think that this is a long-term gain. But that's not the way the rules work. So I want to draw a line through this so that we make sure that we know that that's not the right answer. All right. And the reason it's not the right answer is we look to the underlying stock. We look to the asset to determine the amount of gain and the character. So when did we buy the stock? We bought the stock on 10/3/2022. That's the day that we traded. Our holding period begins on 10/4. And we deliver on 10/5. So how long have we held the stock? We've only held it for one day. Well, if we've held the stock for one day, the $200,000 gain is short-term gain. And we're going to go into further rules on holding period. So some of you might be thinking, oh, well, why don't I just buy the stock, wait a year to make the delivery, and then it'll be long-term gain. They thought of that, and you won't get holding period. And we're going to go more into holding period rules, but you can't get holding period on that stock. So anytime, so the end result from this, and the rule that you can know that comes out of this, is that anytime you sell stock short, that's naked, and I'll explain what naked means. Any gain or loss is always short-term. It can never be long-term, right? Because you've never held any of the stock before. The way you're going to close the short sales by buying new stock. You're never going to have holding period on that stock. And what is naked? Why do they use the word naked? Because you're exposed. Remember, when you buy stock, the most that you could lose is the amount of cash that you pay. So for the buyer of the stock, when they bought it for $1 million, that was the most they could lose. But if I sell stock short, IBM could quadruple, it could quintuple, it could go up 100 times. And as it keeps going up and up and up, I'm just losing more and more money, right? If IBM goes up, IBM increases to 100 million, goes up 100-fold. I sold it short for $1 million. I'm losing $99 million on this transaction. And all I've taken in on day one was $1 million. The most I could have ever made was $1 million, because if IBM would have gone out of business, I would have just kept the $1 million. I would buy back the shares for a penny, return the shares, and I've made $1 million. That's the most I could ever make. But it could just keep going up and up and up, and it could go up to infinity and beyond. But your losses just can keep growing and growing and growing, and that's why they call it naked. When you sell stock short that you don't have a position in, and you're just hoping to make money because it goes down in value, it's a naked position, and any gain or loss. So the same thing is true for losses as it is for gain. That everything's always going to be short term. It doesn't matter how long the short sale is open for, because we look at the underlying stock. All right. Now, there are other rules that come into play in determining whether a gain or loss on the stock is short term or long term. And also, the entering into a short sale is going to impact the holding period of stock that you're holding. So let's assume that I'm holding 10,000 shares of IBM. And I purchased the shares 6 months ago. And my basis in the shares is $950,000. And their value is $1 million. And IBM is going to come out with an announcement. They're going to announce their earnings very shortly. And when companies announce earnings, the price of the stock tends to fluctuate a large amount. A lot of times the earnings are beat expectations and the price of the stock jumps up. Sometimes they're disappointing. They don't meet expectations and the price of the stock goes down. So I want to hedge my position in IBM. I don't want to sell my IBM because if I sell my IBM, I'm going to trigger a $50,000 gain. So I don't want to do that. So the way I can hedge myself is instead of selling my shares, I can sell short 10,000 shares of IBM. Now, when I sell short 10,000 shares of IBM, I'm borrowing someone else's shares. I'm doing everything that the short seller did in our diagram. I borrowed 10,000 shares from someone else. I've sold them into the marketplace, and I received $1 million. This short sale and the holding of the long stock, and by the way, when I say long stock, whenever I have a position in something that I make money if it goes up, I'm going to call those positions long positions. So I'm long 10,000 shares, I'm short 10,000 shares. The two transactions for right now, we're going to talk about a different code section in a couple of weeks. That might change what I'm saying now, but let's forget what I just said. So right now, let's just follow these rules. And then when we talk about this other code section 1259, if any of you are familiar with that, you're going to say that I'm getting a different answer, but we really aren't. All right, but the two transactions are treated separately. All right, so I have two open transactions. I still own my shares. I haven't disposed of them yet. And I've sold short 10,000 shares of IBM, and that's its own separate transaction. The news comes out, and it was bad. And not only was it wasn't bad news, it was good news. And the value of the IBM increases to $1,100,000. You know what? Let me change that. So I apologize. The value of the IBM decreases to $975,000. It decreases to, it doesn't matter what it decreases to, it decreases to $925,000. And now I'm happy that I did that short sale because now I haven't lost any money. The shares that I own long went from $1 million. So let's see, why am I happy that I did the transaction? The long shares were worth $1 million. And now they're worth $925,000. I lost economically, not tax purposes, I lost $75,000, right? But on my short, I received $1 million. And I only have to deliver stock that's worth $925,000. So I have a gain of $75,000. So the two offset each other. It was a perfect hedge. So I'm happy that I did the hedge. But now let's go back here. And what do I do now? IBM came out with bad news. I say, you know what? I don't want to own this IBM stock anymore. And so what I'm going to do is I'm going to deliver my old shares to close the short. All right, so for tax purposes, what's my amount realized? My amount realized is the amount of money that I took in from selling the IBM short. The value of the IBM stock on the day that I make delivery is irrelevant. So my amount realized is $1 million. What's my basis? My basis in the stock is $950,000, right? That was my, because that's the stock that I'm delivering. And I have a gain of $50,000. And how long have I held the stock? I bought the stock 6 months ago. I'm delivering that stock today. My gain is a short-term gain. All right, so let's do the same facts. The only thing I want to change is I didn't buy the stock 6 months ago. I purchased the stock 5 years ago. But everything else is the same. So again, the news comes out, the stock goes down. I say, that's it, I want to get out of the stock. So I deliver the stock. My amount realized is the same. My amount realized is still $1 million. My basis is $950,000. And my gain is $50,000. And how long have I held the stock? I held the stock for 5 years. I have a long-term gain. So just because I did a short sale and I end up with a gain on the short sale when I close it out, doesn't necessarily mean that the gain is going to be short-term. So this is a transaction where I'm holding identical property to the property I've sold short, and we look to the holding period of the identical property to see whether my gain or loss is short-term or long-term. That's the general rule. Now I'm going to go back to the PowerPoint and we're going to talk about exceptions to the general rule, and then I'll come back and I'll do some more examples. So I hope you like that I do examples because we're going to be doing a lot of them. Okay. So the first rule that comes into play is that if substantially identical securities were held for less than 1 year at the time the short is established, or acquired after the short sale was entered into, and this is the key word, any gain on closing of short sale will be treated as short-term gain. So we already talked about if you're naked, that's when you're acquiring the shares after the short sale was entered into. But the other rule that they're putting in is they're saying if you held shares prior to the short sale and those shares were held for less than 1 year, then we don't care what shares you deliver, any gain on the closing of the short sale is short term. So in the example I originally gave you, this code section really doesn't have any major impact because the only shares I held for less than 1 year, and those were the shares I delivered. So my gain is short term, just applying the general rule. Now we come to another special rule, and that is if I own substantially identical securities for more than 1 year at the time the short sale is established, then we don't care what shares you use to close the short sale. Any loss on the closing of the short sale is going to be treated as long-term. All right, and these two rules are, when we start applying them, you're going to see they're anti-abuse rules. And we're going to end up where a taxpayer can end up with some negative tax results. That they're going to do a transaction and it's like heads for the government, it's heads the government wins, tails the taxpayer loses. That the government just always wins. And again, that's just the way the rules work. So how does that type of transaction happen? So let's go back to the example, or back to the whiteboard, I should say. And I'm going to change the example. So now we have a transaction, and it's involving a taxpayer that owns, oh, what did I do? And it's going to involve a taxpayer that's holding multiple lots of IBM. They're holding 2 lots of IBM. So the taxpayer owns 20,000 shares of IBM. Let me get rid of everything. Okay, so they have 10,000 shares bought 5 years ago. And they paid $50,000 for those shares. They also own another 10,000 shares bought 6 months ago. And they paid $150,000 for those shares. And again, news is coming out on IBM. The value of IBM, the value of 20,000 shares is $125,000. So they have a nice gain on the shares that they bought 5 years ago. They have an unrealized loss on the shares that they bought 6 months ago. And they want to hedge 10,000 shares. They don't want to hedge the entire 20,000 shares. So they sell short 10,000 shares for $125,000. And once again, the news comes out. The investor now says, you know what? I don't want to own 20,000 shares anymore. I only want to own 10,000 shares. So I'm going to close the short sale by delivering shares that I've already held. So in transaction 1, they deliver the shares held for 6 months. So we would say, okay, what's our amount realized? Our amount realized is $125,000. What's our basis? Our basis is $150,000. And what do you know? We have a loss. And the loss is $25,000. How long did we hold those shares? We held the shares for 6 months. So under the general rule, we would have a short-term loss. But now we look at those additional rules that I just spoke about. And the second additional rule said that if you, at the time of the short sale, you held substantially identical shares for more than 1 year, then any loss on the closing of the short sale is going to be deemed long-term. Well, we don't, because they're using the word any, they're saying any loss, they don't care which shares you delivered. So we go back and we say, oh, at the time of the short sale, I held shares for more than 1 year. I held shares for 5 years. Well, then if I have a loss on the closing of that short sale, that loss has to be treated as long-term. So because identical shares were held for more than 1 year, at time of short sale, the loss is long-term. All right. And remember, taxpayers don't like long-term losses. They like long-term gains and they like short-term losses. So what's happening here is the government is saying, hey, you have a loss. Guess what? We're going to treat it as long-term. You're not getting a short-term loss. And now let's take transaction two. In transaction two, the numbers are all the same. The only thing is we're going to deliver the shares held for 5 years. So again, what's the amount realized? The amount realized is $125,000. What's the basis? The basis is $50,000. We have a $75,000 gain. We held the shares for 5 years. And under the general rule, that would mean that our gain is a long-term capital gain. But now we go back to the first special rule that I put on the PowerPoint. And that rule says, if at the time of the short sale, you've held identical shares for less than 1 year, then any gain on the closing of that short sale is going to be a short-term gain. So once again, we don't care which shares you deliver. At the time of the short sale, again, because identical shares were held for less than 1 year, any gain is short term. Therefore, a $75,000 gain is short term. So when you start applying these rules, the rules are going to lead you to the result in many cases where you're going to end up, when you have a gain, it's going to be short term. When you have a loss, it's going to be long term. Not always, because we saw if you don't own multiple lots and you own the lot for more than 1 year, and you use that to close a short sale, you could end up with a long-term gain. But if you have multiple lots and some were held for more than 1 year, some were held for less than 1 year, you're always going to end up with bad results for the taxpayer. In these kinds of transactions, your gains are typically going to end up being short-term, and if you have losses, they're going to end up being long-term. So again, it's for the taxpayer, it's, heads, the government wins, tails, the taxpayer loses. And that's the way the short sale rules work in determining the nature of your gain or loss. And again, for our purposes, we're going to always be talking about investors so that the transactions are always going to be capital. I'm not talking about hedgers. We're not talking about dealers. We're not talking about traders right now. We're going to focus on investors. Also, I realize that when I'm typing this stuff, a lot of times there'll be typos in here because I'm typing it as I'm doing this with you. And so I apologize for the typos, but I can't catch them all. And the way this whiteboard works, I can't go back and fix them now. So I know I spelled shares wrong in the second part, where 10,000 shares, I guess, were bought 6 months ago. I can't go back now and fix that off. So we just have to deal with my typos. Okay, now let's go back to the PowerPoint. So now we've talked about the nature of the gains and losses when we close a short sale. There are some more anti-taxpayer rules. The first thing is, what's a short sale? So we've gone over the prototypical short sale. If someone buys a put option, they want to make money if the price of the stock goes down. And so I might want to hedge myself. Instead of selling short IBM, I might have bought put options on IBM solely for purposes of Section 1233. The acquisition of a put is treated as a short sale, but only for purposes of Section 1233. I don't want to get into married puts. The married puts, they're in the code, they're no good anymore. All right. And when we get into straddles, I'll come back and tell you why the married put exception in 1233C is not a viable exception. So what does that mean? That the purchase of a put is treated as a short sale for these purposes? That can have disastrous results. And this actually happened to a client of ours. And we had to work out some sort of arrangement with them afterwards. Because the broker who told them to do this transaction didn't realize the implication of what he was doing. So what was the problem? Taxpayer is holding stock for 11 months. You know what? I'm jumping ahead. Let me go back. I apologize. Let me go back to the PowerPoint because I realize I'm going to get to a rule that I haven't gone over yet. Just know that the acquisition of a put is treated as a short sale for these purposes. So we already talked about the short sale is closed when delivery is made. By the way, if property goes down in value and if the company becomes bankrupt, you've gotten all your money back from the person holding your collateral. Because as the stock goes down, you keep asking for your money back. The stock is now worthless and you've gotten all your money and you're never going to close the short sale. You're never going to buy stock to make delivery to close the short sale. If stock becomes worthless, it's deemed as though you closed the short sale and you have to trigger the gain. Okay, so that's a rule. Now let's talk about another impact on what happens when you enter into a short sale. And then I'll go back to my put example and show you how this can really be a disaster. But if you own stock for less than 1 year and you then enter into a short sale, we saw what it does to the gain, right? The gain will always be short term when you close the short sale. But what it also does is it destroys the holding period of the stock that you're holding. So if you've held stock for 8 months, you enter into a short sale because you want to hedge it. Whatever event occurs, they announce their earnings. And instead of delivering the old stock, you buy new stock to close the short sale. So you're still holding the stock that you've owned for 8 months, that you've held for 8 months. Guess what? That 8-month holding period gets destroyed and goes back to 0. So if you're holding substantially identical property for less than 1 year, at the time you enter into a short sale, you've just destroyed the holding period of that stock. If you've held a stock for more than 1 year, nothing happens to the holding period. So this is only a problem if you've held the stock for less than 1 year. So now let's go back to the example that I wanted to talk about and show you where this plus the put rule can really be a trap. And as I said, one of our brokers fell into that trap. So we're holding stock for 11 months. Excuse me. Our basis is $20,000. The fair market value is $100,000. And excuse me, and we want to hedge. Investor wants to hedge. And the investor knows the rule if they enter into a short sale. So if they enter into a short sale, they're going to lose their 11 months of holding period. And all they have to do is hold the stock for another month and they can get long-term treatment on their gain. So instead of hedging with a sale, they purchase a put, because if they're purchasing a put, they're not selling the stock short, right? In their minds. They then sell, the news comes out, they sell the put 3 days later, and and they continue to hold the stock. And then 2 months later, they sell their stock. And they sell the stock for the $100,000. Assume it didn't move in price. So again, they've got an $80,000 gain. They've held the stock for 13 months. And you would think that that gain should be a long-term capital gain, except that they bought that put after only holding the stock for 11 months. Because the purchase of a put is treated as a short sale only for purposes of this rule within section 1233, that put destroyed the holding period. The holding period in the stock went back to zero. When they sell the stock 2 months later, their holding period in the stock is only 2 months. They've just converted that $80,000 gain from long-term to short-term. It's a trap. So be very careful if you're advising a client and they want to hedge a position on a stock that they're holding, and they've held a position for less than 1 year. You have to be aware that if they buy a put option to hedge their position, that put option is going to destroy their holding period, and they're no longer going to have long-term gain. They're going to bring the holding period back to zero, and now they're going to have to hold the stock for an additional 12 months in order to be able to get long-term gain on the sale of that stock. Right? So the purchase of the put can really be a trap because of the way these short sale rules work. All right, so now we've talked about is the gain or loss on closing the short sale long-term, is it short-term? Just remember there are traps there that what you might think is a long-term gain all of a sudden becomes a short-term gain. What you think is a short-term loss all of a sudden becomes a long-term loss. And also, and the other thing to remember is on a naked short sale where we don't have substantial identical property, it doesn't matter how long the short sale is held open for. All gains and losses on the closing of the short sale are going to be treated as short-term. And let's assume that you have a loss on a short sale, and you really want to make sure that you recognize the loss this year for tax purposes. So you place an order on December 31st to buy back the shares, and you're buying them back at a higher price than what you sold them short, and that's going to be your loss. And you have other gains that you're going to be able to use that loss to offset against. If you buy those shares back on December 31st, when are you going to get the shares? You're not going to get the shares until January 3rd at the earliest. It takes 2 days for the trade to settle. January 1st is a holiday. There's no settlement. That doesn't count in the settlement period. The earliest you could ever get those shares is January 3rd, and you're going to have to make delivery January 3rd. The January 3rd date is the date that you recognize the gain or loss. And so while you think you're recognizing the gain this year for tax purposes, you're recognizing the gain next year. Be very careful. If you want to recognize a loss on the closing of a short sale, make sure that you can make delivery in the current year. Don't do the trade to close the short sale this year, and you're not going to get the shares to make delivery until next year. And if you talk to a broker, you talk to someone who's familiar with investing and doesn't know tax rules, To them, you've closed the short sale on the day you entered into the trade. To them, the delivery is a meaningless thing. And economically, they're right, but the tax rules work off of delivery. So be very careful with that. Okay, so what's the last thing that we want to talk? The last thing that we want to talk about are those in lieu of dividend payments. How do we treat them for tax purposes? So again, we have taxpayer has sold short $1 million worth of IBM. IBM pays that $50,000 dividend. The short seller has to make the payment of $50,000 to the lender of the shares. How are we going to treat the payment of $50,000? So the general rule is in 163(d)(3). It says any payments made in connection with short sale are going to be treated as investment interest expense. And if you're an investor, that's a good section for you to be under. Investment interest expense is deductible to the extent you have investment income, but it is deductible. So the general rule is that it is deductible, except there's an exception to the general rule. And the exception is if you don't hold the short sale open for at least for more than 45 days, you have to capitalize the expense. So now we're looking to not the holding period of the underlying securities. Now we are looking at how long did you keep the short sale open for? And if it was for less than 46 days, so if it's within 45 days, you must capitalize the expense. And what does capitalize the expense mean? You take the expense and you add it to the basis of the shares that you're using, excuse me, to close the short sale. If it's an extraordinary dividend, if the dividend is so large that it's over 10% of the value of the stock, you actually have to keep the short sale open for 1 year. And if you hedge yourself, if you own identical shares, you buy a call option to purchase those shares, you're under a contractual agreement to buy those shares, you don't count those days in determining your 45-day holding period. It's rules very similar to the rules we saw in Section 246. Now there's an exception to the exception. So remember, the short seller is receiving that interest income on the collateral. So the exception to the exception is if you otherwise would have had to capitalize your interest expense, capitalize the in lieu of dividend payment, but you received income and it's referred to as rebate income, then you're allowed to take a deduction up to the amount of the rebate income. All right, and if it's an extraordinary dividend, then they say, forget this exception to the exception. You're just stuck. If you don't hold it open for 1 year, you have to capitalize the expense. So let's go through an example, because once again, when we just go through rules, you might sit there and shake your head, yes, I get this. But until you really do an example, it's really hard to follow all of this, or at least it is for me. So you might be better at this than I am, but I just like to do things with examples. So the first example, let's just make it simple. I sell my IBM short. Again, for $1 million. There's a dividend of $50,000. I pay the dividend. And it's called an in lieu of dividend payment. In lieu means instead of. And I close the short sale after 6 months. Well, since I've held the short sale open for more than 45 days, I can deduct deduct the 50,000 as investment interest expense. And that's the general rule. Now we change the facts. So I'll just do it on over here. Same thing. I sell short $1 million. The dividend is 50,000. I make the in lieu of dividend, but I close the short sale after 31 days. Well, now I haven't held the short sale open for more than 45 days. The 50,000 is not deductible, but must be added to the basis of stock used to close short sale. And then the last wrinkle that we could throw in is we're still in the 31 days, but we earned $3,000 of rebate, which is interest income on the short sale proceeds. So if that was the case, I could now deduct $3,000 and capitalize the excess. So some of you may be thinking, what is this? Why did Congress make up these crazy rules that you have to hold the short sale open for 45 days? Otherwise, you can't deduct the payment. And whenever you see a rule that you've got to hold something open for a certain period of time in order to be able to get a deduction versus capitalizing it, something else is going on. And that's what's going to explain this. So let's assume that I'm an individual and I have capital losses from other transactions of $50,000. And if I have capital losses from other transactions, I'm sorry, sorry about this. If I have capital losses from other transactions of $50,000, they're going to be non-deductible. I need capital gains in order to be able to deduct my capital losses. So what I do is I sell short $1 million of IBM. It's going to make a $50,000 dividend payment. So it's going to go down to $950,000. I buy it for $950,000. And what do you know? I have a capital gain, and I don't care that it's short term, of $50,000. I now can deduct my capital loss because I now have capital gains. And what am I left with? I'm left with the in lieu of dividend payment of $50,000. And I can deduct that as interest expense if there was no 45-day rule. And I've in effect converted a non-deductible capital loss into deductible interest expense. So Congress says, okay, fine. You want to play that game. We want you to take risk. And the risk that you're going to have to take in order to play this game is you're going to have to stay short for more than 45 days. And if you're willing to stay short for more than 45 days, be our guest. And what you'll find is most taxpayers will not do this. Most investors do not like going short securities. And they're saying, no way. If the stock goes up by by 5% during, if the stock goes up any amount, I'm going to lose money. Because remember, this is a break-even transaction. And if the price of the stock goes up, I'm going to lose money. Is that worth the tax benefit to convert capital, a non-deductible loss, into deductible interest expense? And more times than not, you're going to have taxpayers who say, forget about it, I'm not doing it. So that's the reason for the 45-day holding period rule. You want to do this, you want to convert capital losses into interest expense, take economic risk. You're willing to take the economic risk, go for it. And that's why if it's an extraordinary dividend, greater than 10%, the 45 days becomes 1 year. And now they're telling you, well, you know, IBM is trading for $1 million. They're paying a $200,000 dividend. If you could convert $200,000 of non-deductible losses into ordinary deductions, you'd be willing to take the risk for 45 days. So now they're saying you want to do it when the numbers get really big, so it's really worthwhile. Well, we're going to make you take more risk. Now you have to be short for over 1 year, and you really can't hedge yourself. And because you can't hedge yourself, taxpayers do not want to do this transaction. And this actually works. Congress deterrent to get people to stop doing these transactions, in this case, is effective. People do not like going short. Many people don't like going short to begin with. And if you're telling them you've got to stay short for 45 days on a regular dividend or over 1 year on an extraordinary dividend, they're not going to do it. And that really wraps up our section on short sales. So I have, why do we need these rules? That's the reason we need these rules. There is a transaction that you can enter into to achieve similar results. There are bonds that trade flat. And what a flat bond is that the price of the bond goes up for the coupon that's attached to it. It's not treated separately. And for those bonds, you end up with the bond. Let's assume there was a bond for $1,000 that has a 10% coupon, which I know don't exist. There aren't too many of those anymore. But again, just for our purposes, I've got a $10,000 bond. It's about to pay a $500 coupon payment because it's semi-annual. The price of the bond actually will go up to $10,500, and then it'll drop to $10,000. So if I sell that bond short the day before a coupon payment, I can sell it short for $10,500. It will then drop to $10,000. I'll make $500 on the bond. I'll pay out the $500 coupon payment, and I'll get the result that I couldn't do with stocks. And because the code section that puts in the rule to capitalize payments only applies to dividends, doesn't apply to bonds, that transaction can still be done. So these are the things that people think about. These are the things that people do. But for the most part, if you're doing it with stocks, the capitalization of the in lieu of dividend payment really works. All right. So there will be a homework assignment that goes along with short sales. I'll ask a lot of questions regarding all the stuff that we spoke about, that I spoke about today in this session. And that's it.